Next panel is Lumos Data, Brett Caines and Corey Jones, and they are a new company specializing in small business loan data. I've partnered with them in what I'm doing on our default analysis and rates, and I'm going to let them talk about what they do. Brett?
Thank you, Bob. Good morning, everybody. Thanks, Bob, for the intro. As Bob said, today I'm going to be talking about using data to guide your business strategies. Specifically, in this case, we'll be talking about small business lending data appropriate for the venue, of course. A lot of this is going to be geared toward the origination or lending side. That's typically where our client base is. But I think as we start going through this, you'll see that it applies to sort of a broad spectrum of the small business lending or small business loan origination realm. Thank you. And then specifically applies to sort of the SBA world. And when we get in toward the end, we'll look at some data sort of real time, but we'll talk about defaults there, prepayments. And I think within that data set, you'll see how this is applicable, sort of the secondary market activities for broker dealers buying those guaranteed loans. For those of you that don't know me or haven't met before, my background is from Live Oak Bank. I was part of the organizing team there. I was there for 15 years. I was CFO and then left 2 years ago to start Lumos. Corey Jones came over as well from Live Oak. But one of our focuses at Live Oak, our main focus really from the time that we started, the bank was sort of a niche focus on small business lending. And in the case of niche for Live Oak, it's focusing on industry verticals and trying to understand how you can best serve those industries and be the most valuable banking partner that you can be by having sort of that laser focus. And a large part of that was focusing on data to make decisions and drive strategies within those individual industries. 2 years ago, I started Lumos. I started working with Bob Coleman a little earlier this year. Our goal really in that case is to honor the kind of the torch of SBA data that Bob's lit, similar with the other Bob from GLS, everything he does on the data side. The Bobs, got to meet with the Bobs, but really kind of expand that to some ways to help originators make good decisions. So when talking about data, large data sets there's certainly a lot of opportunity there, but it's not without its challenges also. Thinking of the challenges, probably the biggest one is having the skill set, the resources internally at an institution to actually understand the data, to obtain data sets, to clean those data sets, and then make decisions on those data sets. So there's a very high R&D cost, a high sort of human resource cost to make that happen. And that's where I think partnering with other providers can make a lot of sense when that expertise is not sort of in-house. But even with those challenges in mind, you also have to recognize the massive opportunity that's available. And especially as it relates to small business lending, you wouldn't be wrong to think, there's so much small business opportunity out there. Why have sort of this data focus? There's certainly plenty of small business lending to go around without really expending this effort into this data analysis to drive strategy. because the market is just so large. But with the use of data, you can make quicker decisions, faster decisions, and then really start automating portions of your business as well. So to break down the opportunity a little bit, this is a number that everyone has heard before. It gets repeated very often. There's 33 million small businesses in the United States that make up 99% of all businesses in the US. But as you dig into that a little bit more, the numbers, it becomes a little more revealing. Of those 33.2 million small businesses, a lot of those are shell companies, probably not the right word, but it's an entity that's been formed and nothing happens there. There's no employees. It doesn't really do anything. So if you break that down into small businesses that actually have an employee base, that number is a little over 6 million. So 6 million sort of small businesses out there that are active and looking for financing. From a Federal Reserve study, I think this was done 2 years ago, and it covered a 5-year period. 40% of that 6 million number, 40% of those small businesses look for financing every single year. So that's 2.3 million small businesses seeking some form of capital every year. If you think about the SBA 7A program, that's 50,000 loans a year, roughly, made in that program. Depending on how I rounded the 2.3 million, you could take out that 50,000 and you would still be at 2.3 million. And certainly there's a lot of conventional lending done on top of that, but that's still a large market. And a lot of those loans are simply just falling through the cracks. Ones that do may have a higher risk, may just be something that a bank cannot get around to. And in a lot of cases, what falls through those cracks are probably the smaller dollar small business loans. And if a bank has opportunities coming to it, they tend to focus on those larger dollar loans because of the inefficiencies associated with that smaller dollar small business lending. SBA did recently make changes to help motivate and incent banks to focus on those smaller dollar small business loans. And that's really wonderful, but it's going to take additional steps by lending institution to really be able to do those efficiently. From a study that we did internally, if you look at a loan that is below $500,000 and compare that to loans above $500,000, just looking at operating costs, for those loans below $500,000, for those to be as economically or financially efficient as those larger dollar loans, you have to reduce those operating costs by 6x. That's pretty significant. So while the SBA program changes will help bridge that, also using data for decision making to speed up decisions, some level of automation is also a very important factor in there to be able to get those smaller dollar loans to be as efficient as or financially efficient as doing those larger dollar loans. On the bottom right hand side here, so just kind of starting to get into the data, we're going to sort of slow walk into deeper and deeper levels of data. We tend to focus on expected loss, and there's been a lot of discussion about prepayments today. We have prepayment data as well. We tend to look at the financial impact of expected loss, but just very generically, and this wouldn't be enough to make a true decision, but just kind of as a step into that decision making. 22% of all industries have an expected loss rate below 2%. So of the 1,000 NAICS codes available, via the SBA program, 250 of those are going to have an expected loss below 2%. This is very easily within the acceptable risk profile of a bank. And then on the other end of that, 13% of those 1,000 industries have an expected loss rate above 5%. That's pretty much out of the realm of what a bank would want to do. But that's 150 industries of the 1,000. And then sort of in between that 2 and 5, and certainly below 4% expected loss side. That's an area where banks focus on, where does it make sense to lend, mitigating risk. If you want to eliminate risk, you're heading down to the other end of that spectrum, but that's also shrinking your market. But how to mitigate risk kind of between that 2% and 5% expected loss range. So just to show how large this opportunity really is, and then seemingly the lower risk nature bucket that's out there of 250 possible industries. And just a note on, again, this kind of touches on the small dollar lending that I mentioned previously, but the average size of an SBA loan has increased from 368,000 7 years ago to 540,000 last year. Certainly, inflation is a piece of that. Equipment costs are going up, building material costs going up. But nonetheless, there is a place where small dollar lending can be increased. Interestingly, 40% of loans under 350,000, I'm going to round it up to half. It's pretty generous rounding. I'll say half. Half of all the loans under 350,000 are originated by just 5 banks. So that's certainly a place where an entity interested that can figure that out, how to do it efficiently. It's certainly a place that's not saturated by a lot of competition. So just to look at the data, again, sort of stepping into this, there's lots of data available. SBA generously provides access to SBA loans. And just going back to 1995, there's 2 million loans in that data set. That's a very robust data set. Back to 1995, there's 400,000 charge-offs. I'm sorry, 400,000 defaults, 300,000 charge-offs. So you can see there's sufficient data here to start making decisions. Just to give a sort of an egregious example or an extreme example, imagine you're at a bank. This actually probably has happened before. Imagine you're at a bank, you make 2 veterinarian loans, and both of those veterinarian loans default. Credit department comes out with a policy, we are never going to do another veterinarian loan, they all default. That is a correct conclusion based on that data set. All of their vet loans defaulted, therefore they're not going to do it anymore. But you have to recognize the limitations or how faulty your conclusions can be when your data set's limited. Hopefully that wouldn't ever happen. Won't be surprised if it did. But just to illustrate the importance of having a robust data set to make sure you're drawing the right conclusions. And with a robust data set, you can start layering analytics on top of that to determine things like probability of default, loss given default, expected loss, and prepayments. So in addition to that, we'll call it a bucket 1, sort of the quantity of data. It's important to have a large quantity of data. The second part is a time horizon. If you have 2 million loans, so you've got a large quantity, but that time period covers 2014 to 2018, that's not very helpful in drawing conclusions through different economic cycles. So as mentioned, the 2 million SBA loans that can be obtained just going back to 1995, that's nearly 30 years of data, and you're covering various economic cycles in that case, from dot-com crash, early 2000s, to Great Recession, and then most recently COVID. So you can really start seeing loan performance through different environments so that you're making better decisions based on the robustness of that data. So thinking quantity, time horizon, and then the third piece is quality. You need to have appropriate quality of data to make sure you're determining or making your best decisions. And we've all seen data sets. No human is perfect. No technology is perfect. There's going to be errors in the data set. So we go through a really significant data cleaning and standardization process, important for making sure the data you have is accurate. Just a couple of examples I think will resonate with everyone. If thinking in terms of industry codes, NAICS codes, or franchise codes, those tend to change over time. Whenever NAICS codes are updated, new NAICS codes are added, some NAICS codes are removed, and those industries are collapsed into another NAICS code. So we standardize those over time. Same thing with franchise codes. Just an example there, Dairy Queen, you're interested in data on Dairy Queen, you go and you type Dairy Queen, you're going to get a set of data. If you haven't cleaned and standardized, I guess standardized, if you haven't standardized that data, you're going to miss out on all franchises that were coded as DQ or franchises coded as DQ, grill and chill. So by searching Dairy Queen, making sure you get that broader spectrum that encompasses all Dairy Queens, regardless of the franchise code that was in play at time. And then sort of on loan terms, this kind of goes back to the imperfection of humans or even the imperfection of technology. It's not uncommon for an interest rate to be blank, an interest rate to be zero, a maturity to be missing. Having a zero value or a null value in your data set is much worse than replacing that null or zero value with an appropriate best guess. So we use algorithms to fill in blanks in that case. So if an interest rate's missing, looking at the loan type, the loan size, the maturity of the amount, and looking at other loans, what the average interest rate is there, and then populating that interest rate with a best guess. So just the importance of having a clean, quality data set. And from there, you can start drawing conclusions. So there's a map here. I'm going to ask you guys to draw a conclusion from this map after I explain the legend to you. So we code everything down to the county level. The darkest blue color, that's the lowest expected loss. So that's the lowest risk. The lighter shade of blue, slightly more risk, but still really low. And then yellow to orange, with orange being the counties with the highest expected loss occurring there, or the most risky loans. So just with a quick glance at this map, what conclusion, this is the interactive part, what conclusion could you draw from looking at this map?
South is not a great place to be.
that tends to be everyone's first answer. But so from the idea of being careful of the immediate conclusions that you draw and needing to look more granularly into data, that could be a correct conclusion. I don't know if that's the right conclusion or not, but yes, the loans there have higher expected losses. An alternative view there would be the blue counties really aren't leaning into lending. Are they appropriately serving their clients? If this, whatever county this is up at the top here, that county, they do one small business loan and it performs well, they're going to have the lowest risk. But have they really moved the needle from a small business lending standpoint? The answer is no. So maybe it's the South is leaning into small business lending, and the blue counties aren't leaning into small business lending. So being careful of what immediate conclusions you draw without looking deeper into the data. Is any number, really. Quick summary of some of the things I just said. So opportunities, clearly from a biz dev standpoint, there's a large market out there, a market that really can be accessed through automation, through data to make better decisions. And I think often when I say markets, folks' minds typically go to geography, want to break into the Indiana market. But really it could be anything. At Live Oak, a market was defined as an industry. Maybe your market is that below $350,000 small dollar market, from on a really broad geography. So different definitions there, but helping you understand how to get into those new markets. And then credit metrics, obviously, we mentioned default, expected loss, prepayments, understanding those as you enter into those markets, but then also understanding your existing portfolio and then informing your different credit risk models like CECL. So quick example, there's two examples on this page. On each of these next two slides, I'm just going to focus on the ones on the left. So thinking about franchise lending. So imagine a strip mall, there's an empty leasehold space, it's designated, perfect place for a limited service restaurant. It's probably easy to think, it doesn't really matter, just limited service restaurant is going to do fine, it's in a strip mall. Jimmy John's, Dickey's Barbecue Pit, those tend to show up in sort of similar locations, but the performance of those two have been significantly different. Jimmy John's expected loss 0.77% compared to Dickey's Barbecue Pit 5.85. So much higher likelihood of default on your Dickey's Barbecue Pit compared to historical performance, or using historical performance as a proxy. And then prepayment speeds, the Jimmy John's is going to prepay much quicker, but just from a total prepayment default plus voluntary prepayment standpoint, Jimmy John's still a better bet in that case. I mentioned earlier, going back 30 years, looking at data and kind of the various economic cycles you have there. One of the things when you get into data, one of the things that's important is, or powerful, I should say, is starting to layer data sets together. So with that legacy or that historical SBA loan data set, obtaining data sets from Federal Reserve Economic Database, Bureau of Labor and Statistics, U.S. Census Bureau, some of these other data sources, start identifying correlations between those data sets. And we use machine learning to do that. But what you can start to see is, if you look at inflation levels in a certain time period, or unemployment rates in a certain time period, stock market volatility, VIX is another one that we look at, 10-year, 2-year spread, start building correlations between changes in those factors and what was going on in the legacy SBA portfolio at the time. And then you can understand how unemployment rates are going to impact your loan performance. Something like residential remodelers, those are going to be highly impacted by interest rates. You have some industries that higher unemployment, those loans in that industry actually perform better. So a lot to think about, and just a lot of power in kind of layering those data sets together. I'm going to do something a little bit risky for this next section. That's what Corey Jones is going to help me with. So this is just sort of a real-time view of some of our data. So the first thing you're looking at here is probability of default. I think Scott mentioned earlier, it's kind of in those first years, you've got that sort of immediate ramp up of performance. And from there, it sort of levels off. And on the bottom left, I was talking to Kevin earlier, you can also start to view performance like this in different buckets. So what we were talking about, how do smaller dollar loans perform compared to larger dollar loans? And in this case, again, this is default we're showing, but those smaller dollar loans, you see that default ramp up very quickly. And that's in line with, smaller dollar lending is inherently much more risky than larger dollar lending. And then in the bottom there, you see the blue lines. Those are more the larger loans. And so that total default is much lower, but then also doesn't have that, immediate ramp up like those smaller dollar loans do. Do you want to switch over to total prepayments? Yeah, and on the right, we'll see how long this takes to load. Hopefully not too long. It's a bit Wi-Fi dependent. But even with it shaded here, you can see on the right, looking at those different loan buckets. Oh, there you go. So down, you have these in the term loans. You can see from a total prepayment standpoint, those smaller dollar loans, just kind of looking at the 100,000 to 350,000, bucket, year one, 2.8% total prepayment, 6, 10, compared to, the $1.5 to $2 million bucket, 0.7, 4, 9, 10. So really, you can start digging into and seeing how loans perform over and sort of different buckets. And just like you've done here with loan size and drilling into industries, drilling into franchises like we talked about earlier, as long as you've got a robust data set that covers that industry, that covers that franchise, you can make quick, meaningful, impactful decisions with that. And then probably the last thing I show. Yeah, let's try it. So in a sense, you start out, like if you think of this as sort of, we'll start running this because it'll take a minute to run. So Cosmos Club reception yesterday evening, type the word social there. So industry code, yep, that's it. 20, that's fine. Yeah, that's fine. So if you think of this all in terms of steps, first step is you find a data set, and it's massive. It's got 2 million loans in it. You have to start taking steps to bring that data set into a form that you can actually use to make decisions. And somewhere along the way, that data set becomes a more clean Excel spreadsheet. What are you going to do with that Excel spreadsheet? You can filter it. The dashboard we just showed is really just an intuitive version of a spreadsheet that you would filter. But there's still a level of work and assessment, kind of back to what skill sets are inside of an organization to actually dig into data like that. So then this step is kind of a next evolution of that. Where can you start taking those data sets, looking at sort of clean, filtered, I'll just say pivot table for lack of a better word, and then really start using that to make decisions in the quickest, most efficient way possible. And that's sort of the step. That's good.
It's typically about 15 seconds on your home Wi-Fi, your business Wi-Fi.
So what you can start. So in this case, looking at an individual business. The first section up here is we've actually moved from historical expected loss in this case to predicted expected loss. So using those historical data sets to actually build predictive models. And in this case, we use Data Robot or Databricks machine learning to do that. But giving the user an idea on a very individual business basis how that business might perform. So in this case, Cosmos Club, the expected loss 3.98% on a $150,000 line of credit. The factors bringing that risk or increasing that risk are the current 10-year, 2-year Treasury spread and that loan amount. So historically, loan amounts of that amount haven't performed well. But then generally, providing a quick overview of the business. This section is pretty much taken from Cosmo's website, so pulled in directly via ChatGPT prompts for familiar language, at least present day. Looking at how that SBA historical data is relevant to this specific loan, just industry overview in general, industry benchmarks, helping with industry valuation metrics. Again, prompting, using OpenAI prompts to get sales and marketing strategy, reviews, and then looking at competitive landscape. In this case, what lenders are very active in the county that Cosmos Club is in. What lenders are very active in the sector that Cosmos Club is in. What lenders are very active in that industry. Really, so a bank, if it's going after a certain market, will kind of know what the competition is there. The pricing, in those same buckets over the prior 36 months. Earlier, there was a question sort of on stress testing. This doesn't stress test from an individual business cash flow standpoint, but using data that's quickly and publicly available where something like cash flow might not be early in the process to get an idea of what a stressful situation might look like for a loan. So in this case, if you recall from the top, expected loss for this was 4%. In a more recessionary environment, that expected loss is going up to 10%. In a boom economy, it's 1%. So again, it's not using cash flow, but just historically, loans of this size, this loan type of line of credit, and in this industry, how they have historically performed through those environments. And then generally, I mentioned other data sources. I mentioned VIX. We show just providing trends on that. And really the point here is hopefully to have shown going from sort of that raw data where you're like, what in the world am I going to do with all this, to something that is very, very specific to an individual opportunity that a person might be looking at.
Hey, Brett, that's great. Are we able to get a copy of that? We can send out?
Oh, yeah, absolutely. Yeah.
Awesome. Very good.
That's it. If there's any questions, happy to take questions. I think I'm a little over schedule.
You are. We're going to yank you off.
Sorry.
Any questions for Brett?
All your data comes from SBA.
Small business data comes from SBA, and then on top of that, for the macroeconomic stuff, that's Federal Reserve Economic Database, FRED, Census Bureau, Labor and Statistics. But this correct, yeah. But I will say to that, if you think about the SBA program and kind of how it changes from time to time, loans that fit, Bob stood up, that's not a good sign. Loans that fit into an SBA bucket today may not fit into the SBA world 2 years from now, and vice versa. So there's kind of that flow where conventional lending makes sense at time, and then sometimes those loans end up, kind of going through the SBA program because of prevailing conditions. So, I think to say that, I still think there's relevancy to conventional lending via, how the SBA has performed. So.
Brett, this was all individual loan based, right?
It is. It's not pools. Correct. Yeah.
Is this from FOIA, the data, or are you taking raw data from the SBA directly?
Yeah, so it's all FOIA requests. There's the public file, that's made available to everyone, and then we do a handful of other sort of private requests to the SBA. Thanks.